Good evening, party people. It is that time again here on Thursday evening, 7 p.m. Keith Pitch here, Mortgage from a Treehouse. Welcome to it. We have a great little tidbit here tonight to share with you about the mortgage documentation, right? We had some of our prior listeners, watchers, I should say, prior watchers. I come from radio. I did radio for about a year and a half, 2 years. And so I'm thinking in the radio mindset. But anyway, we had some amazing folks type in and say, hey, we want to know about the documentation that goes into a mortgage. So what better conversation to have tonight than talking about the documentation that we put into a mortgage that you guys got to supply us. I mean, so it's been something of a moving target. And I say that for this one sole purpose. Similar to how we were talking about pricing mortgages and how rates are different, because each one of you had a little bit different of a dynamic, whether that is your credit score, whether that is your type of house that you got, your down payment, you name it. There's a million different things that we could go into and say, hey, this is why your pricing is different than somebody else's. And we could also say, hey, your pricing is different because yesterday prices were better, today prices are worse, right? So documentation, I hear sometimes from people that are looking to get into mortgages that, hey, guess what? You know, I'm a little scared because I heard from my friend that the documentation process, the mortgage process was just like pull my hair out craziness. And there's lots of documents that I have to provide. I don't have 16 years worth of bank statements, and I don't have my blood type on file. So I don't know if I want to get a mortgage. I get it. It is overwhelming. And I just want to kind of peel back the onion, so to speak, tonight and just show you guys how easy it really is. So let's jump into it and move on through. Okay. So the question is that I get all the time, what documents do I need? What goes into a mortgage? This is the $1 million question. Again, it's a choose your own adventure book. But for tonight's purposes, what I'd like to focus on are 4 topics, right? Topic number 1, income. Topic number 2, assets. Topic number 3, credit. And then finally, everything else. Just a couple miscellaneous housekeeping things that sometimes get overlooked or get forgotten about until we get to the end where we need them and say, hey, I need this. So wanted to go through those. But first and foremost, I have to give a little bit of a disclaimer. Right? I'm going to make this big so everybody can see. This is Fannie Mae's single family mortgage underwriting guideline. It is 1,205 pages long. This is Freddie Mac's underwriting guideline. It is 2,130 pages long. This is where I live my whole life in these 2 documents and FHA. I didn't put FHA in here. FHA is actually right between the 2. So between the 3 major credit underwriters for mortgages, which probably securitize and underwrite the super majority, I'm saying 80+% of all loans in the United States, you know, the smallest guide is 1,200 pages. The biggest guide is 2,100 pages. What I say this for, and a quick disclosure, is we can't cover every little nuance. So I'm going to keep this probably at about 7,500 feet, not 10,000, not the 1,000 foot level, but about 7,500 to 5,000 feet. We're going to be right in there tonight. And if you have questions as we go through this, by all means, please do just type in the chat bar. Let me know what your question is, and we can address it tonight. So we're actually getting one-on-one counseling, so to speak, one-on Facebook Live counseling. So moving right along. Let's start with income. And the income is, we'll start with our basic worker, the 9 to 5, 40 hours a week, or salary person, and just steady Eddie. You know, here's what I make, right? I get paid $40 an hour. I work 40 hours a week. Here's my paycheck. Or I'm on salary for X amount a year. Here's my paycheck. I love you guys. I'm just going to be honest. I love you guys. You guys are so quick and easy. I need a pay stub and a W-2, and we're off and running, right? So your pay stub that covers the most recent 30 days. Sometimes that's one pay stub, right? If you get paid once a month, like teachers get paid once a month. Boom, paycheck stub. That's all I need. One. And I need your W-2. Right now we're here in 2021, so I need 2020's W-2. Simple, easy. You guys are done. Kick it back in your lazy boy. Put your legs up. You're good to go, right? So again, I love the typical just easy Eddie employed person. Now, there's the next person here is the RSU. We get this question a lot. So you are again the 40-hour worker on a salary on hourly pay, and you have RSUs. RSUs are restricted stock units, right? So a lot of our friends in tech, a lot of our friends in medical get paid this way, right? It's a very common practice. So here's the thing. You still have to provide us the pay stub and the W-2, but now when we look at, for your base salary, now when we look at bringing the RSU income into the equation, we have to have vesting. Vesting. That is the key to success for you guys. And here's how it works. We need to show that you actually claimed it as income. So you had vesting history that showed up on your W-2 and you claimed it on your taxes for 2 prior years. And then from when we underwrite your loan, we need to have a continuance, because that is a product of the Dodd-Frank, that we have continuance for the next 3 years on your vesting schedule. So long as we have those 2 key pieces, and that is typically either the front side, getting it for 2 years, or the back side, the vesting for the next 3, is typically what trips up most RSU qualifying people that want to use their RSU for qualifying income. So in that case, if you don't have that matrix, that you have the 2 on the front, 3 on the back, then guess what? All we can use is your base salary. So still a good number, but it's not including your RSUs unless we can jump those 2 hurdles. This gets a lot of people that they get out there, they get pre-approved. Here's how it can get you in trouble. And I just want to make sure that you're going through a full underwrite where you're providing all your income and asset documentation when you get pre-approved. What happens is, have a quick conversation over, online with somebody or over the phone with somebody, and they say, oh, how much money do you make? And you, by default, include your RSU income, right? And when you include the RSU income, guess what? You can possibly be overqualified, because when we back that number out, now we have less income to qualify you. So that can get into a sticky situation that you want to be careful of. So RSUs totally acceptable, so long as you meet the 2 requirements. Moving right along. Now we're getting into our variable worker set, right? So our variable workers are those guys that have flexible hourly schedules and or overtime, right? So let's say we go out there and we have a job that we work somewhere between 29 and 40 hours a week, right? And it fluctuates, goes up and down, up and down. So same with overtime. Maybe we work our regular 40 hours a week, but sometimes we have 2 hours of overtime, and other weeks we have 10 hours of overtime, just killing it that week. Awesome. But how do we look at that? What do we need from you and from your employer, more importantly, to qualify that income? Great question. Again, we're going to grab your pay stubs for the most recent 30 days. We're going to grab your W-2s for the last 2 years. And then we're going to get what's called a verification of employment, right? So what we'll be asking for in this scenario is that we'll say, hey, Joe borrower, I see that you have a variable portion of your income, whether that's overtime or hourly, right? We talked about that. But we need to talk to your human resources department, and I'm shaking my screen here. Sorry about that. We need to talk to your human resources department and get a verification of employment to see what the 2-year history is. So we will then take that document, send it over to the HR contact, HR manager, whoever handles payroll kind of thing for your company, and they will complete the verification of employment. So with those 3 items between your paycheck stub, your W-2, and the verification of employment, we can take care of that and fully calculate out your variable portion, whether it's your hours or overtime. Now let's talk about the calculation really quick. When we calculate variable incomes, and you're going to see this repeated over and over when we get into self-employed and commission folks, when we validate variable income, let's say overtime income, you work your full 40, we get your full 40, we credit the full 40 to your qualifying income. Now we have a second bucket of overtime income. Let's say in 1 year, you have $1,200 worth of overtime, and the next year you have $2,400 worth of overtime. What we'll do in 2019, $1,200, 2020, $2,400, we slam them together, we add them together, so we're up to $3,600, and we're going to divide that by 24 months. That's going to be your effective bucket that we can use for overtime. So it's a blended rate over the 2 years of what your overtime is. Now, there's one key caveat that a lot of people don't understand here, that is if 2019, let's say 2019, you had the $2,400 worth of overtime, and 2020, you only had $100 worth of overtime, right? And we have a huge decline. Decline's greater than 30%. We have to take the most recent year and divide by 12. So instead of adding the 2 together and dividing by 24, we're going to take the most recent and divide by 12. This is a reoccurring theme with self-employed, commission, any variable aspect of your income. That's going to impact your qualification. So what's really important is we, again, get into pre-approvals. We go through the refinance process and we get those verifications of employment. We get them out of the way and done as soon as possible so we know what your bona fide income is. So there's no surprises when you're under contract. That's my number one motto is when you're under contract, there should be no mortgage surprises when it comes to income, assets, or credit. Those should all be ironed out and locked tight. Moving right along, as I've been alluding to, those variable worker commission income folks, raise your hand if you're there. I'm a commission income folk. Similarly to everybody else, we still need to see your pay stub. We still need your W-2 for the past 2 years. And then we're going to do the verification of employment. Same rules apply, right? So if 2019 you killed it, 2020 you didn't do so well, and there's a decrease in income, we're going to use the 2019 as a sole average over 12 months. So again, we got to get those verifications of employment done. We got to get those bona fide numbers dialed in. So again, there's no surprises. And then also there's possibly, in the commission space, there's possibly a reason to pull your tax returns if there's any deviations on your W-2s or 1099s as far as your income is concerned. So if there's write-downs or you're writing stuff off that we can see through a W-2 or 1099, we could ask for your tax returns as well. So just keep that in mind for all the variable income folks out there. Now, that takes us to the next level of employment status, like income verification. The income verification for the self-employed individual. This is where the rubber meets the road, and I just want to really define this so everybody's aware. You are a self-employed individual in the eyes of an underwriter if you own 25% or more of a business. So sole proprietors, guess what? You're 100% yourself. You own yourself. So you will always have to supply tax returns. If you're in a business and only own 10% share, you'll need to provide a K-1 statement, but not the whole business tax return, right? The other caveat to this, if you guys have passive income streams, that could be rental properties, that could be dividend income, that could be any of that, and you want to use it to qualify, you will be classified as a self-employed individual, and you will be required to provide tax returns. So just know that going right out the gate, like, oh yeah, I make my income over here, but I also have dividend income coming in to the tune of $10, $12, $15,000 a year that I want to use. Okay, now we're going to get out of just providing a paycheck stub and a W-2, and I need to see your full tax returns. So be prepared for that. Moving along. So what do the self-employed individuals need? Not only do we need to see your personal tax returns, we also need to see the business tax returns. And sometimes this gets a little bit tedious, especially with minority owners of businesses that are like, hey, I only own 30% of this business. Why do you need my business tax returns? It's a requirement. You have to see what the business is filing as well as what the person is filing on their tax returns. So super important to know that up front. Now, I will put a little caveat in here. I say tax returns for 2 years. Here's a cool thing. For all of you that have been self-employed for 5 years, number one, round of applause. You made it past the 2 years where 80% of all businesses fail, which means you are doubled down and you've really just, you're crushing it. So congratulations on that. If you made it 5 years self-employed and you go Freddie Mac has a cool little caveat that we only need 1 year's worth of tax returns. Super awesome, right? Fannie Mae, I can't say that definitively. They go back and forth depending on the business, depending on this. Sometimes they do only ask for one. Sometimes they ask for two. I know that Freddie, if you're 5 years in that same line of work, self-employed, you only need one tax return, which is awesome. Because again, when we talk about good year, bad year, maybe you had a bad 2019, but 2020 is awesome, and you've been in business for 5+ years. We could just use the 2020 income to qualify, and we don't have to go back over the last 24 months. Boom, powerful, right? Powerful, powerful, powerful. And then finally, the year-to-date profit and loss statement and balance sheet, right? This throws everybody off. Like, does it have to be audited by my CPA? Do I need to get my bookkeeper to do it? What does it have to be? What if it's off by $10? This is really, what this is only a litmus test of where the business is since they last filed taxes, right? Here we are in, wow, it's the first week of March, you guys. First week of March. Happy March. The line is back because it's starting to rain. I hear it's starting to rain right now. So the line is coming back. It came in like a lamb for 2 days. Now it's coming back to a little bit of rain. Anyway, I digress. So getting back to it, the year-to-date profit and loss is only a signal of how the business is doing and is it keeping pace with the last filed tax return. That's really what the underwriter is looking for. Again, going back to that continuity of income we were discussing with the RSU income, they want to see continuity that the business is on the same pace with same gross revenues that are coming in and same net revenues roughly year-to-date to make sure that there's no decline in business activity. So the underwriter's duty is to make sure that there is a continuance of income as stated on the calculation. So that's where they're coming from. It does not have to be audited. It does not have to be run by your CPA. None of that is required. All it has to be is just the year-to-date profit and loss and balance sheet. For all of you out there that are self-employed and running QuickBooks or any of the other bookkeeping services, super easy. You go into it, punch up year-to-date profit and loss, boom, PDF, you're done. So super, super powerful. Moving right along. Retired folks, getting loans all over the place. So retired individuals are super awesome, super easy. Benefit award letters from your pensions, from your annuities, from Social Security. That's all we need to show. That's it. All done. No tax returns, no nothing. You're good. So simple, easy. I love you guys too, just as I love the basic salary and hourly individuals. I love all the other people in between too, the self-employed. You guys are challenging, and it's fun to work on your deals because they're not just click it and off it goes. So retired folks, absolutely, we can get you done as far as award letters are concerned. Cool thing about the retirees, in some cases, when the income is non-taxable, depending on how much money you have coming in retirement, if the income is non-taxable, Sometimes it can actually be grossed up by 25%, right? So that's pretty cool. If your Social Security, excuse me, if your Social Security benefit was $1,000, so to say, for an example, and it was non-taxable, what we could do is gross it up to $1,250 to help you qualify with a grossed up income. So super powerful, super flexible. So that's all I wanted to cover tonight with income. There's a lot of different caveats and rabbit holes that we could go down, but not tonight because I can't believe that we're already 20 minutes into this. I got to keep going because I got to get through assets and credit. So assets, what you're seeing here, folks, we refer to this right here. We refer to this as mattress money. Yep, it's cash. It's cash. But in a mortgage application, it's not acceptable, right? We can't have mattress money in a mortgage application. Nope. It's got to be bona fide, documented, and seasoned money in a bank account somewhere, right? So they have to be in a bank account for 60 days, right? Anything less than that, you're subject to questions by the underwriter. Anything has to be sourced and seasoned, right? If the source is not acceptable, the seasoning has to be 60 days before we can use that on your mortgage application. So now that we know what we can use, let's talk about the types of accounts we can use. We can use bank statements, checking, savings, CDs, all of that is considered money. Money market accounts, good to go, right? What we'll be asking for in that respect is 2 months worth of bank statements. Now, here's the thing about bank statements. I got to take a drink of water. The thing about bank statements and quarterly investment statements is there's always that one page, that one pesky little page that says this page is left blank intentionally, on purpose, whatever, and here's what happens a lot with bank statements. People don't include that that page in the bank statements. Though it says number 6 of 6 at the bottom, they don't include it because, oh, hey, why would the mortgage company want a blank page, right? The reason why we want that blank page is because it says 6 of 6. And if we only have the statement that has 1 of 6 through 5 of 6 and not the 6 of 6, it's actually incomplete documentation. So the best thing to do is take the whole statement, send it over to us. Investment statements are even worse because they'll have blank statements intermittently dispersed, and then they'll have a disclosure page, and then they'll have another blank page, and then they'll have another disclosure page, which has nothing to do with your account, nothing to do with paper trailing your assets. It just has everything to do with their disclosure requirements, but you leave those out, and then you have to resend it. So remember, make sure that you include all pages of your asset verification because it just causes headaches otherwise. Transaction history. Here's a cool thing with transaction history. In today's world, you provide the bank statement, right? Let's play this out a little bit. Why we would need transaction history. You provide the bank statement, right? So you get pre-approved. You've given me your bank statements for today's, like I said, March 4th. You've given me February and January's bank statement. Awesome. You're pre-approved. You're ready to go. Now, tomorrow you find a house and you write what's called earnest money. You write a check from your checking account and it goes to the escrow account. And now I need to have proof that that money has come out of your bank account. So now we can go transaction history. Transaction history can come straight off of your bank's website. So long as it has enough information, like the last 4 digits of your bank account number that we can match it to your statement, and it has some sort of identifying, whether it's your last name, some identifying feature that it's your bank account, right? So long as we have those 2 things, we can totally do that. Again, if there's page numbers on it, we need all pages, even the blank ones. Sounds crazy, but we need the blank pages. Now, I say all that and all that craziness to say, let's talk about digital verification. This is real talk. I started doing this a long time ago with one of my fellow coworkers and like, okay, real talk time. Let's talk about this. The mortgage world, and I'm going to show you guys, it's going to blow your mind something here in just a minute. But the mortgage world has moved digital, right? We are digitally verifying assets. And I just want to talk really quick about roadblocks. I've had clients come to me and say, oh, Keith, I see that you want me to verify my bank account and log in and send you my snapshot of my bank statement. I just don't feel comfortable signing in and linking that to you. Number one, it's not a forever link to your bank account, right? You're going to sign into your bank and it's going to populate your transaction history for the last 60 days and then disconnect the connection. Number one. Number two, the situation that we have is you're loading up your bank account statements. So you can print off your bank account statements and then upload them to the system, which we have everything that would have been digitally verified. But now you've spent 20 minutes, a half an hour to log in, download your statements from your bank account onto your desktop, right? Which you have a higher likelihood of having a virus or a worm on your laptop than having an integration error with any banking system these days. We are so highly regulated with the integrations and the firewalls that we have to prevent any issues from outside hackers trying to get into our system, that you're better off linking that straight through the websites from your bank to our website, as opposed to saving that stuff on your desktop and then uploading it to our website. So that's the real talk. We need the information. How you want to get it to us, still completely up to you, but it's easy, it's convenient, and it's safer. So I definitely urge everybody to digitally verify if and when you can. Moving right along on the assets. Let's talk about the earnest money. The earnest money has to be put into the escrow account within 3 business days, right? You signed the contract, you got 2 more business days to get it into escrow, right? So that earnest money always causes headaches because we have to get that transaction history through the mortgage process. What happens typically? Here's the conversation piece. Oh, I've already given you my bank account statement. Why do you need more information? We have to see that the earnest money has cleared your checking account to credit to you on the closing statement. So super important there. The other thing in purchases that screws up the whole process, that makes huge headaches for borrowers and underwriters in closing on time, is gift funds. Let's talk about gift funds. Gift funds are awesome ways for those of you that need a little extra or don't have any down payment and you have a relative that wants to give you gift funds. Now, gift funds, this is my professional opinion. Gift funds should never go from the giftor who's giving you the funds to the borrower, in my opinion. They should always go from the giftor straight to the escrow team. That is my suggestion. It's so much cleaner because here's why. If we go from giftor to the escrow company, it's one transaction that we have to document. The grandpa, father, mother, uncle, cousin, they give the money, boom, goes to the escrow account. The escrow company sends us confirmation that Jimmy Gifter gave us the money. Great, all done. Sign the letter. Your gifter signs the letter. You sign the letter. All done. If the gifter gives you the money and then you have to give the money to escrow, now we're going from giftor to you, now you to giftor. So my suggestion there, agents, I hope you're listening to me on this. My suggestion there is to make sure if we're having gift funds, they go straight to escrow. So much easier, and that will ensure a cleaner process and will increase your likelihood of making sure you close on time. Super, super, super important. Now, the last one that I talk about in assets with purchases, and this also flips over to refinances, is reserves. Reserves are required documented assets that are in a bank account somewhere post-closing. Once you've made the down payment, once you've brought in the funds to close, that you still have X amount of dollars in the bank, right? In conventional land and FHA land, there's not necessarily a huge requirement for reserves if you're buying an owner-occupied property. Second homes, non-owner occupied properties, and jumbo loans require reserve requirements, right? They require you have reserves after you close. So after you write that check to escrow and you have paid for the closing and the down payment, you still got to have 6 months, 9 months, 12 months of payments in the bank, right? These have to be documented just like any other asset. 60 days, sourced, seasoned, and in the bank account. So I say that because sometimes the reserve requirements are overlooked. Oh yeah, I'm going to write all my money and put all my bank account into this, and I'm going to have $7 left over when I'm done. We've got to make sure that we have the proper reserves when you're buying second homes, investment properties, or you're in the jumbo market. So keep that one in mind. Finally, what is not allowed in the wide world of assets, right? Unsourced deposits and cash, aka mattress money. I showed you guys a picture earlier. Mattress money, you can't just pull it out from under your mattress and throw it in the bank. It's got to sit there for 60 days before it can be used. Application date can't even be within 60 days, right? So we want to make sure any unsourced deposits, here's a couple things that are unsourced. Let's say, or here's how this will play out. Let's say that you make $5,000 a month, and there's a deposit in the bank account that came in for $3,000. It's not tied to your employer, and so we need to ask about it. So we're going to say, hey, Joe Borrower, what is this $3,000 deposit that's in your bank account? Oh, that was XYZ. You know, I sold my baseball card collection. I sold my Beanie Bears or whatever. I sold this, I sold that. Can you document it? Yes or no, right? Do you have a purchase and sale agreement? If you can't document it, it's considered unsourced deposit, and I can't use it, right? Super important to make sure the money is right up front. Other things that you can't use, cryptocurrency. Cryptocurrency has to be liquidated out of Bitcoin or whatever the other ones are. I know Bitcoin, that's it. So you got to liquidate the cryptocurrency. It's got to sit in the bank account for 60 days before it's valid as an asset on a mortgage application. Proceeds from unsecured loans, credit cards, and credit card advances. I've seen this play out all too often that clients get referred to me. They got turned down from another lender. I pull up their bank account statement and say, oh, wow, hey, I see that $5,000 is in your bank account. Where did you get that? Oh, I maxed out my credit card. That's a problem. We can't have unsecured debts as collateral, as seasoned funds, right? So that would have to sit there for at least 60 days before it could be valid on an application. There's different ways to go about that. So make sure that we have those conversations before you execute on those plans. So just they're not acceptable. What is acceptable is, like, say you had a car, right? Oh, hey, I had an extra car or a travel trailer or something that's got a title that you can have a bill of sale and track it. You can totally sell something like that. So finally, let's talk about credit. Credit. Letters of explanation. So on your credit report, this is a report that looks back over the last 10 years of your life. 10 years. So there's going to be addresses from where you lived and you applied for credit in that past 10 years. There's going to be credit cards that have been closed that may come up and be asked. There may be names, right? My last name is Pitch, Pitsch, right? So there's a variance on my credit report that I know about because when I made a credit application with a credit card company, they spelled my name wrong, right? So now every time that I do a mortgage, they say, hey, there's a variation on your credit report spelled Keith, Pitch, the regular pitch in the ball, right? So every time I do a mortgage, I get to write a letter of explanation that that is not my name. Somebody must have taken a credit app and misspelled my name. My name is Keith Pitch, Pitsch, right? So those kind of things come up. If there's ever a derogatory account in the last 10 years, so you could forget about this. Like, think about that. 10 years ago was 2011, right? In 2011, did you have a derogatory account? Maybe you missed a credit card payment. So why did you miss that credit card payment in 2011? Oh, I can't remember. I haven't done it since. That's all you have to do. They sometimes come off as people take them as annoying little letters to write, but they do have to be dictated and put in the file to make sure that we're addressing all the concerns when it comes to making a credit decision. So embrace them. They're part of the process. But when you think of these obscure things that come up, we are looking back over the last 10 years. So it's kind of crazy that way. Payment histories, credit and payment history. So here's a cool thing that a lot of people don't know about. So if you are still watching the show at this point, awesome. I'm like 5 minutes over my half an hour that I was trying to keep, but good for you. For those of you that have maybe co-signed for a car, for a friend, a family member, a daughter, what have you, the cool part about it is if you've co-signed for a credit account and somebody else has been making that payment and you can document that they have made that payment for the last 12 months, we can take it off your debt to income ratio. So often I see this play out with parents of children who they purchase cars for, and the kids have been paying, they co-signed for the car, right? So the $300 payment, it's showing on the parent's credit report, but the son has been paying it. They pay it every month, and we can document that they paid it for the last 12 months. I can back that out of their debt to income ratio. I have it sometimes where people co-sign on mortgages, right? Hey, my brother needs somebody to co-sign on this mortgage for him. I'll go co-sign. And if I can show to the creditor that my brother pays for that mortgage for the last 12 months or since inception, right? I can back that out of your debt to income ratio. So that's how you can help your credit out too in getting qualified. So super, super awesome there. And then recent statements for items being paid off for refinances, right? Whenever you go do a cash out refinance and you're consolidating debt, the escrow company will go out there and get the payoffs for the any mortgage debt on the title of the house, right? But if you're paying off car loans, if you're paying off consumer debt, credit cards, what have you, you have to provide statements and payoff demands to escrow. So sometimes that gets a little bit complex and overwhelming to some people. I've had it where I've helped folks consolidate 10 different lines of credit into a new mortgage and pay off all their credit and get a really great savings on a monthly basis. And now they have to provide not just their mortgage statement, but they have to provide each credit card account statement as well as pay off demands for any installment loans. So those are the credit must-have. Now, to put a pin in it tonight, this is a lot of information of documentation that you got to come with. So just be prepared. If you know it, it's not that bad because you can contextualize it. If it starts coming at you piecemeal, one piece at a time, it can get overwhelming and seem long in the tooth. Remember this when it comes to documentation. As you provide documentation to us on the mortgage side of the coin, something in that documentation may spur us to ask another question and ask for more documentation. So just because we ask for, hey, let me have your tax returns so I can get you underwritten, your tax returns may spur additional questions and additional documentation requirements. So don't be upset when we come back and say, hey, I need one more, or can you write a letter of explanation for this, or can you do this for me because I didn't get that stupid page on the bank statement that was left intentionally blank by the bank. Come on, let's go green, people. No intentionally blank pages anymore. Anyway, so keeping that in mind. Now, here's the cool part, the creme de la creme. I mentioned earlier that mortgages are going digital. I mentioned earlier that we can digitally verify your bank account, and it's a safer way to do it, quite frankly, to directly link and transmit the data that way. This is a true example of a loan that I'm doing right now. What you guys are looking at, I'm going to make this full screen. What you guys are looking at, this is called, I call this the green light special. Green light special, right? So this loan is approved. This loan has a property inspection waiver. So we did what's called an automated valuation of the house. And the automated valuation said, yep, the house is worth what you said it was worth, right? Then we digitally verified this borrower's income using ADP and paychecks. They did not have to provide a W-2. They did not have to provide a bank statement. We digitally verified it. And This borrower chose to digitally verify their assets. Boop, boop. Done. Green light. This person, this is how I'm going to transition to the next slide. This person only had to give us the one miscellaneous thing that we haven't covered yet. This is awesome. This person is super happy. We literally originated this mortgage on Monday before last. We started this mortgage on Monday, the 22nd, and we're in final underwrite now to get this refinance done for this person. It's awesome. It's powerful. And guess what? It's super easy. So if you guys think mortgages are tough, if you haven't got a mortgage since 2014, the world has epically changed. So final thing, the only thing that borrower had to provide to us was a hazard insurance binder. That's it. Whoops, I gotta go back. I clicked on the slide and it went forward. So they had to provide their hazard insurance. That's it. So we could get an updated insurance binder. Ta-da, all done. So the everything else, super important piece of documentation. It's not a mortgage document, but it does hold up mortgages, and I want to talk about it. And if you ever have questions, reach out to your mortgage professional, reach out to me, reach out to the escrow company. Escrow will send you documentation. Escrow is, again, that third-party service that helps record and take off old mortgages that are paid off and record the new mortgages and transfer titles and all that stuff. So they have to do their job, and they're going to send you escrow docs, and you need to complete them and send them back. So if you have any questions about those, or you're concerned, oh, hey, they want this, they want my social security number, they want my full legal name, they want this, they want my date of birth, I get it. Verify with them, verify with me, your mortgage consultant, but make sure that you do not delay in getting those back. Because if we don't get those back in time, it can hold up signing. Holding up signing means it's holding up funding, which means we're not going to close in a timely fashion. So definitely make sure that you address those, sign them, and get them back. And finally, sometimes we do need identification. Based on if there's any fraud alerts on credit reports, if you are here maybe on a non-permanent basis on a visa, you can buy a house. If you're here on H-1B, a lot of different visa types, you're allowed. If you are here on a non-permanent basis, we would need to see your visa type and passport. So that's when identification comes in. But past that, we've covered the big bases, and we're rounding home here. So if you guys have any questions, again, please, by all means, ask. That's the goal of this little project, little experiment in my treehouse is, yeah, that is my treehouse. That is my treehouse right there. That's where I'm sitting in that little window. So the goal of this is to empower you, to educate you, to add some context to a process that you've maybe never gone through before, or to update you on the process that is today. We have new home buyers and old home buyers and people that are getting new mortgages for the first time in 5, 10 years, right? So that they have the same different questions, or the same questions, they have the same concerns about digital verification and what mortgages look like today. So if you have any questions, by all means, please let me know. Please do, if you found this helpful in any way, share it, like it, comment. Let us know what we can do to help you and to address any questions that you have regarding mortgages and real estate. Finally, I invite you guys to come back next week where we're going to talk about non-QM mortgages. So these are mortgages that are thinking outside the box. They're not Fannie Mae, they're not Freddie Mac, they're not FHA. These are for self-employed individuals that don't have any qualified income. These are for real estate investors that want to use rental income to qualify and not put their income on an application. These are for folks that want to close and purchase real estate in an LLC or a corporation. So if that interests you, next week, we'll see you same place right here, live on Facebook and YouTube, and we'll talk about non-qualified mortgages. Until next Thursday, I'm Keith Pitch, and you're here with us with Mortgage in a Treehouse. We'll see you next week.